Good afternoon, ladies and gentlemen, and welcome to the AFERIAN interim results for the 6 months ended the 31st of May 2021 investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your InvestorMeetCompany dashboard, and we will notify you by email when they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you would give that your kind attention, we would be most grateful. And I'd now like to hand over to Donald McGarver, CEO, and Mark Carlisle, CFO from AFERIAN. Good afternoon to you both.
Thank you. Thanks, Mark, and good afternoon and welcome to everybody. And we're just going to take you through a bit of a presentation, a few slides, and as Mark said, please, if you have any questions, please put them in the Q&A section. We'd be delighted to try and answer them as best we can. So first of all, I guess there's three kind of key points I want to try and get across today. One is we've seen good growth across all of our metrics, but specifically in recurring revenue, which is very much the focus of our company, very much focus of our software and services business. We've made good strategic progress against our 2025 strategy, which I'll talk about later on. And, you know, this improvement in ARR, the focus that we have in the business is giving us really good visibility. So it gives us a lot of confidence in not only the second half of this year, but actually going into 2022 and beyond. So just to highlight some of that, as it says, strong progress in the period, the first half of this year. Revenues were up nearly 20%, but most pleasingly for us, the big focus around the business is about increasing recurring revenue. That was up 37%. Some of that, half of that came from an acquisition we did towards the end of the first half, but you know, really strong organic growth in our ARR. EBITDA was also up with double digits. We announced the dividend, a 1p dividend. We'll be paying that in September. And in the period, we also did a placing. We raised £9.4 million. It was actually for a potential acquisition that we were doing at the time through an auction. We were unfortunate not being successful there, but we have retained those funds so that we have some ability to find, to execute on other transactions should we have the right ones available to us. We also, in the period, we changed the name and the structure of the group. I do assure everyone that no external consultants were used or abused in the making of the rebrand. It was very much an internal exercise using our own resources, but it really reflects better our growth ambitions and give a bit more clarity to investors, prospective investors, new investors around our goals and our aims, whereas the old sort of group had kind of was confusing that a little bit. What is really important is that our go-to-market brands, 24i around software and Amino around devices, remain intact. That's what's valued and that's what's active in our respective marketplaces. So very much you know, an exercise we did ourselves just to get a bit more clarity around the growth and, you know, how the company is structured going forward. And we did get a small M&A activity going in the period. So we acquired a company, Nordia, based in Copenhagen, a streaming and pay TV specialist. As it says there, it was 5.3 million euros. We paid for that. It's very complementary to our products and our platforms. It's earnings enhancing, and it added a couple of $1 million to our ARR. It also really is strategically important. It helped accelerate our plans for this TV as a service, the ability to offer a full end-to-end service to our customers so that they can achieve their ambitions in terms of moving their products and solutions forward as well. 24i as a division or as the brand had a very strong period. As I said, the real focus there is growing our recurring revenue, and we saw a 47% increase year over year, and that was really coming from the kind of there's a couple of metrics just to support that below. One is when you look at our end-to-end platform, we saw over 100% growth year over year, more than doubling in the period. And then when you look at our applications, which we provide through what we call our next-gen platform, we saw a 23% growth there, over the 6 months of the first half of this year. Norgia integration's underway, and as I said, that will accelerate some of our offerings into the market. And we announced a number of new customers and expanded some of our relationships and partnerships. A really good example is Canadian Hockey League, where they've taken their hockey content and, as well as going through their traditional broadcaster operator routes, they're actually providing that direct to consumers as an offering over the top. And we put that together along with a partnership with Verizon Media to deliver that. And we're seeing more and more of these kind of sports franchises and content owners want to do a similar thing. Customers like Cable Nord, Pureflix, both of those, we expanded the relationship. Pureflix, which had been taking our applications, is now actually taking on more of the platform. So we're able to sell more of our offering into existing customers and expand that relationship and expand and grow our subscriptions and our recurring revenue. And Amino, the device business had a very strong period. Revenues up 25%. A bit of that came from the difference between last year, where there was shipments were stalled out of China for a few weeks, but the vast majority came from an increase in demand. And you'll see that actually the volumes were up quite significantly. We've seen the average selling price come down a bit because they're more for streaming services and they have less hard disk drives and storage in those. They're actually very highly functional devices. But again, we've seen the volume increase quite significantly there. Even more pleasingly is that our software, our SaaS platform for managing those devices has been adding to our recurring revenue. We saw a 22% increase, and that continues. And we've continued to take additional market share by offering more services as part of that platform and moving that forward as well. One of the features has been the deployment of Android TV. And in some cases, with the integration of Netflix, we are what's known as a Netflix Hailstorm partner. That means our relationship with Netflix allows us to be pre-integrated with Netflix so that we can launch this in very short timescales and much shorter than others can do it. That advantage has helped us win some of the opportunities you see below with Optage, PCCW, Go, and CableNet in Cyprus. PCCW is a really interesting one. It is an existing customer, but they've now moved to Android TV, and they asked us to produce all of the software, which we license to another hardware manufacturer, a Chinese ODM. And then we also receive a subscription for PCCW to provide our Engage platform across all of those devices. So really sticky, valuable software and getting that on other people's devices and into our customers. I'm sure you've all heard a lot about supply chain challenges and shortage of chips. We have mitigated and managed to sort of navigate our way through that very successfully in the period. What we've seen mainly is, we have strong relationships with the suppliers, but by working closer with our customers, we were able to get better visibility, more commitment from them so that we could then make commitments on our suppliers over the long term. So we've managed to kind of navigate through that. We've been satisfying our demand. The one thing is lead times have gone up significantly. We used to talk about 8-week lead times on things like silicon. Now it's 26, or in one particular case, 55 to 60-week lead times. But as I said, managing our commitments and our inventory, we've managed to make sure that we can navigate through that. By asking our suppliers to take on more of that inventory on our behalf as well. ESG, Obviously, we hear a lot about ESG from investors and shareholders who want to, this has become very important to them. I think for us, it's become extremely important to our employees. In an engagement survey we did at the back end of last year, more than 90% of our employees said this was very or extremely important to them, and they wanted to work at a company that took this particularly seriously. So if you go to our AFERIAN website, we've got under ESG, you can actually, there's quite a bit of detail on what we're doing. Of course, we're doing all the regulatory stuff. We're signing up to the appropriate standards, but we wanted to go beyond that. So we are committing, some of our resources, our people, our product, our profit, to addressing what we chose, or employees helped us choose, was 6 of the 17 United Nations Sustainable Development Goals. So this is something that is is important to us as a company and as a set of engaged employees, as well as to many of our customers and to our shareholders as well. And we've branded it under a term called Ikigai, which really is about making where you work aligned with your goals and sustainability in the environment as well. I'll hand over to Mark if he'll take us through some of the numbers.
Thank you, Donald. So as Donald mentioned earlier, revenue up to 45.3 million, and that's been driven from the top line from an increase in the number of devices, as Donald talked you through in the previous slides. Excuse me. Software and services revenue is an area of focus from us, and that's increased to $9.9 million. But more importantly, within that, we've increased our annual run rate recurring revenue to $13.8 million. And 2 million of that increase was driven by the acquisition of Nordia at the period end. But we also saw really good, strong organic growth of 17% in that number, as the team's really focused on that. As part of our 2025 strategy, we've got a target to get recurring revenue being 70% of our total software and services revenue. And we've increased that now to 56%, which is a key KPI for the business. The increase in revenue has fallen down to adjusted EBITDA. So you can see increased in adjusted EBITDA to 8.3 million this period. And we also maintain strong operating cash flows. And I'll talk you through the working capital and other movements of those on the next slides. These are really just to show you what we as a management team look at in terms of driving the value in the business going forwards in terms of recurring revenue. As I mentioned, software and services revenue recurring now up to 56% and exit ARR up to 13.8%. And we expect those numbers to grow again in the second half. Moving on to the income statement, you can see the impact of the revenue increase on gross profits, and that falling through to adjusted EBITDA increasing to 8.3 and operating profit increasing up to 5 million. You'll notice that on the gross profit line, you'll see the gross margin declining from 51 to 46%. That's really as a result of product mix. The more lower margin devices that are sold as a percentage of total revenue decreases that number. And on a full year basis, when we take out the impact of phasing of device sales from H1 to H2 and look at it on a year-on-year basis, we expect the overall margin to increase as a result of the increased software and services, and in particular recurring revenue in the full year. We have some exceptional costs in the period relating to both the Nordia acquisition and also the MobiTV bid that we invested in, which brought our profile of the group significantly up in the North American TV operator space. Moving down the P&L, you can see in terms of movements, we've had a decrease in amortization of acquired intangibles, as the intangibles acquired with the Books Media and Entone assets have now been fully amortized. In terms of the tax charge, we have fully utilised now the UK tax losses and the US tax losses that were in place that were covering the Amino division profits. That Amino division, as you can see from the segmental analysis, is profitable, and now we are paying tax in that region and on that IP. In terms of the 24i division, we maintain tax losses there, and as that moves into profitability, that will start using up those tax losses in the Netherlands and in the Finland region. Moving on to the balance sheet, you can see an increase in the non-current assets as a result of the acquisition of Nordia. Despite the supply chain increases in lead times, we've maintained good control over inventories, And really our investment in the supply chain is investment in longer term commitments rather than actually inventories on the balance sheet. In terms of the working capital, which has impacted cash flow, and we've seen a 4.3 million working capital outflow during the period. That's as a result of the timing of device sales in Q2 versus Q4 in the previous period, and also the amount of credit given to certain customers that were sold to in that period versus the previous period end. Those of you that have read the detail of the statements will see that our debtor days have increased from 23 to 39, and that's really a function of the terms of those customers taking that order rather than customers paying late. The other large item to point out is that the 24i put option has been exercised, and the board has taken a decision to settle that 2/3 approximately in shares and 1/3 in cash, as you can see from the statement here. Moving on to the cash flow statement, you can see the impact of the movement in working capital and operating cash flow, and we expect that movement to unwind in the second half. In general, our business does have intra-quarter swings of anywhere between $5 and $8 million working capital, which is funded by the facility we have with Barclays and the cash on hand. Our exceptional cash items here of 2.2 also includes 1.8 million deposit so that we could bid on the Mobi TV assets. Once that closed and TiVo bought that asset, we were refunded that within one business day on the 2nd of June. Our capitalized development costs have increased. That's in line with our plan to better productize the 24i platforms and also invest in our software and service device management platform, which, as you've seen, is growing ARR significantly in the period. We've also declared an interim dividend of 1p, which we paid in September, as Donald mentioned, and we continue to have a good level of liquidity with cash on the balance sheet of 17 million and an undrawn facility at the period end of 8.1, giving us a total of $25 million available cash on the balance sheet with our Barclays facility. In addition to that, we have an additional 10 million accordion facility with Barclays, which, if exercised, would give us current facilities of about $35 million cash.
Sorry, just unmuting myself. So if I can talk just briefly about our strategy and our markets. I think it's important really to understand that our customers are pay TV operators, broadcasters, content and media owners. But what we're really trying to help them address what the consumer, the end consumer, people like you and I really want. And what they want today is to get the traditional TV, but they also want access to all that live streaming, that OTT content, that all of us are absorbing every day. And really our vision is to make it easy for people, for consumers, to connect to the TV and the video they love, and to do that anytime, anywhere, and on any device or any screen that they might want it. So, we're really focused on that, particularly bringing this OTT streaming capability to all of our customers, all of who demand it. We announced back in February our 2025 strategy that you're probably familiar with. Again, all around our products and solutions about giving this best of both worlds, about offering choice, convenience and usability and access to all of the entertainment and video that we want to get to. And the financial goals were about tripling our revenues, most of those coming from software and services. And within that software, 70% of that being recurring, as Mark alluded to earlier. That is very much our target to get to, and actually we've been moving towards that quite successfully. And that is a combination of organic and M&A growth going forward. And one of the things is we do have, our platform. We've got one platform, but that is actually allowing us the flexibility to deal with many markets. And even from traditional pay TV operators, it's all about bringing these OTT services to bear. As it says there, the vast majority of operators, particularly in EMEA and North America, are integrating streaming because that's what their customers now demand. They want all of the content, or as much of the content as possible, coming from one place. And if a pay TV operator wants to be successful, that's what they have to offer going forward. But we're seeing that impact also in broadcasters. So traditional broadcasters, NPO, the BBC of the Netherlands, also want to get their content to consumers in a different and in a new way. And then sports operators, again, not satisfied with just going through the traditional channels. They want to get this directly into the hands of consumers. And that's what we're doing for the Canadian Hockey League, and one I've talked about before with Cable and Wireless and Flow Sports, about bringing that to customers who aren't on their networks or aren't being provided by them initially. And then, of course, there's the content owners. Now, I think we all know that the streaming market is going to increase quite significantly. It's expected to triple by 2026 to $210 billion with 1.5 billion subscribers. And when we think of that, we think of Disney and Netflix, and we think of Amazon Prime, etc. But the reality is most of that is coming from all this other content that is now starting to flow over the top via streaming services. And that's at the heart of what we do for those customers. And some of them you see here, and others that we have in our pipeline. And just to give you a picture of, where do we compete? Well, we compete in 3 real areas: video platforms, applications, and devices. But most importantly, we're kind of unique in that we can offer all of those as an end-to-end solution. And we're obviously able to then cross-sell some of our offerings into each of those, competitive areas. And you'll see some maybe be familiar or not so familiar with Cultura, one that actually just IPO'd on the NASDAQ a few weeks ago. When you look at their platform, very similar to the way that or the approach that we've taken about addressing through one platform, several markets. But as able to compete in all those marketplaces with the solutions and the products we have today. And then obviously the strategy, a part of that strategy is obviously organic, but a part of it is inorganic through M&A. So this is just kind of highlighting where in our sort of ecosystem where we see the opportunities. We've identified gaps that we'd like to fill. We've got partnerships that we'd like to maybe bring some of that into our own ecosystem as part of our end-to-end service. And then we've got areas that we'd like to consolidate and some of the market opportunity there. So this kind of lays out where the pipeline for us and our M&A ambitions is and what we're looking at and the kind of things we're looking to try and achieve. So really, just in summary, our software-led strategy is delivering growth, particularly on the core metric that we're really focused on, which is our ARR, and that continues to be a focus. Providing great solutions and services to customers and making sure that they want to stick with us is really important to us. We've kicked off our strategy. It's now well engaged, and that will continue to drive this software-led growth. And actually, overall, the kind of performance we've seen in the periods, the things that we're doing in the business, it just gives us a much more enhanced visibility and gives us confidence, not only this year, but actually 2022 and beyond. So all in good shape going forward, aligned with and positioned with the strategy that we've put in place.
Donald, Mark, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review the company questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your InvestorMeetCompany platform. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation has ended, we'll redirect you for the opportunity to provide feedback in order that the company can better understand your views and expectations. Donald, Mark, I know you've expanded on some of the questions that have or touched on some of the questions that have come in, but perhaps I could just hand back to you. If I could ask you where appropriate to read out the question and give a response, and then I'll pick up from you at the end.
Okay, we'll do. I've got one here from Andy. Do you see future growth as organic, or do you see it coming partly through M&A? What do you look for in a potential acquisition for it to get your attention? I've maybe partly answered that, but it is very much a combination of both. I mean, our organic ambitions are that we expect to grow 15 to 20% per annum in our software and services, and we expect to increase our ARR proportion up to that 70%, and that's what we're looking to achieve organically. We do, obviously, to hit the kind of numbers that we're talking about, we will do some M&A. Nordia was an example of that. And where we're looking is within the ecosystem that I highlighted earlier, to find things that fit in there, that add value to customers and help us consolidate and grow our opportunities in the marketplace. So Nordia was a small one, but I think very complementary and fits right into our sweet spot in terms of how we can grow and be successful with customers across these markets.
Shall we go with an exciting tax question, Donald?
Why not?
Yeah, so we've got a good question on tax. Do you expect a similar tax percentage in H2 as in H1? Yes, we do. As I mentioned, those taxes are paid on the profits of the Amino division. And then when do you expect the 24i losses to be used up? I think certainly we've got enough tax losses to cover our sort of projected losses over the next 3 years. So I would pencil in a similar tax percentage looking at the Amino division as you see today going forwards. That's probably the best thing to do there. Another financial question on the annual recurring run rate. So how does ARR, how does exit ARR correlate to next year's revenue? If software and services exit ARR is 13.8 million at the half year, should we be penciling in that at least for H2? Yes, so what we look at, that 13.8 million is the contracted run rate recurring revenue at the end of May. So all things being equal, and we retain all those contracts for the next year, we would have 13.8 million recurring revenue for the 12 months beginning the 1st of June. Clearly, we are growing that, and as we implement customers such as CHL, that number will grow. We do have a lag between when we take on customers such as CHL and do the setup, and then when the ARR kicks in. So as long as we keep winning customers and our customers keep growing, which they are doing, because a lot of that revenue is predicated on numbers of users, numbers of devices, then our recurring run rate revenue will keep growing.
We've got a question there. Are you based in the UK or do you have offices globally? Yes, we have some operations in the UK. Obviously, myself and Mark sit here in what we like to call, rather than headquarters, or support centre. But actually, we have a small number of people in the UK. So our operations are global, close to our customers. Our biggest centres are in Amsterdam, in Brno in the Czech Republic, in Helsinki in Finland, and in Hong Kong. And then the rest of our teams are spread really out across the world, close to the customers.
Yeah, we have about 350 employees from 34 different nationalities operating out of 17 countries, I think is what our stats are, Donald.
Yeah.
Perfect. I don't know if there's anything further, Mark or Donald, but I think from what I can see, those questions that are appropriate to answer, you've been able to address this. If there's anything further, please do stop me. But if not, perhaps, Donald, I could hand back to you for a few closing comments before we redirect investors to provide you feedback.
Yeah, well, listen, thank you. Appreciate everybody's time. Thanks for joining us. As I said, we're executing well on the strategy, really focused on growing our recurring revenue, and we've got really good visibility going forward. So, we've ploughed through COVID relatively unscathed, and we've continued to move forward with our strategy. So we look forward to executing on that and sharing those results with you going forward.
Mark, Donald, thank you once again for updating investors. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. Excuse me. That will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all. Thank you.